What's going on? What's going on, friends and family? This is your man, Jason O. Miles, and the O is my middle initial, right? So if you was looking for me, you got to use the O, because if you use just Jason Miles, another guy will pop up that sings music and plays guitar. His name is Jason Miles Goss, but he's been around a little longer than me. But hey, listen, welcome. Thank you for stopping by. Today we're going to talk all about how you can become a private money lender, right? And what that means. And for some of you that are watching, you're going to want to know, well, how can I raise private money? This is equally as much for you as it is to the individual that's watching that, wants to, excuse me, I had a brain fart there, that wants to become a private lender and utilize all the resources they have available to them. So without further ado, I'm going to go ahead and get started and get yourself something to write with. I know you're going to need it. It is what it is. I'm going to go over some facts. I'm going to give you everything that you need to know so that you can be an effective private money lender on your own. Ready? Let's go. Being a real estate investor, there's nothing to it.
Sellers are just waiting for my call. Hey.
I'm sick and tired of y'all calling me. Stop calling my phone. I'm just sick of them. Sick.
So basically, there's no competition.
All I have to do is mail these out. Boom. Here comes the money.
Real estate. Easy money.
Hey, get away from my car.
My offers are solid, and they always get accepted.
Be nice.
As real estate investors, we make our own hours.
Now all I have to do is put in these bandit signs.
If you invest in real estate, you know exactly what you just saw. It can be problematic, right? It's the same group of people going after the same group of people saying the same thing to the same group of people. I get it. I've done it all. Some of those strategies can work, but it's all about messaging and numbers. But I'm here to tell you today that there's an absolutely better way to get things done, that you can double what you're doing. If you're a full-time investor already, you should be doing 5 to 10 deals a month. If you're not, let's have a conversation. If you're just getting started, this is the best way for you to go and get started. If you don't have any money to put into marketing and you want to develop a pipeline of deals that's consistently coming through, and you don't have to have the exact same conversation over and over and over again with another new seller. All you have to do is watch this study that I've put together for you. It's a little bit of a training, and let's have a conversation afterward. I've been at this for more than 2 decades, and we've developed strategies and relationships and systems and processes that allow our business to do 15 deals, 12 deals a month per market that we're in. And I want to share this information with you. Click the link below. Let's have a conversation. Peace. All right. Welcome back. Yes, if you want to know how to work with me and how you can get to where you want to go faster, click the link in the description. Check it out. Schedule an appointment. Fill out the little form. If you're interested in having just a conversation, we'll go from there. Now, back to the business at hand. What does it mean to be a private lender, right? What does it mean? Well, basically, it means that you are the bank, okay? You're the bank. And I wrote a few things down I'm going to go over with you. But you're the bank, and you kind of control the terms of what that looks like. So what is a private lender, right? I'll go right here. A private lender is an individual or a company that privately loans money to other individuals or companies. Now, what does that mean? Okay, that just means that if you have some money, and again, this isn't just for people that have 50,000, 20,000, 100,000, million. It doesn't really matter. You may have 10,000, you may have 15,000, you may have 20,000, and you're like, that's not enough for me to get involved in a real estate deal. It's not enough money for me to buy. And you may be right as it relates to that, because it does. Even if you're doing hard money, it takes some money, right? It takes money 99.9% of the time. It doesn't mean that it has to be your money, but it does mean there's going to be some money that transfers somewhere, okay? So as a private lender, people will look to you so that they can invest in real estate. However, you have to make sure you vet that person, right? You want to make sure that person understands exactly what it is they're doing. Or if they don't, maybe you trust that person, but it's a new venture and you're not sure about them, but maybe they have a partner that has all the experience that makes you feel comfortable from that, from that perspective, right? Because that's important. You want to make sure that when you lay your hard-earned money in someone's hand, however you do it, and we'll kind of go over what that looks like, because you're not literally handing it over. I mean, you shouldn't do it that way anyway, but, the brown paper bag days, forget about it, right? So you got to have your paperwork in order. And once you've got that in order, of course, you have done it because you're comfortable with the people that you're working with. You're confident that they can get the project done in the time that you have agreed to, that both parties have agreed to. That's extremely important. You don't want to go into, a 6-month deal and it drags out for 2 years. Now, if you're being compensated and you don't need access to that capital, then okay, fine. But, we'll talk about what that actually kind of looks like as we move forward. But it's one person or one entity. And yes, you can do this out of your IRA or your 401k. You can invest. If you don't just have a check to stroke a check, you don't just have it sitting in the bank. You can invest and grow that money tax-free, which we'll talk about as well in this time that we have together today, about how that plays out. How can you grow it exponentially? How can you grow it, outside of the traditional ways that you would grow your money in an IRA or a 401k? Well, real estate. And we're going to kind of get into that. But, what are the benefits? What are the pros and the cons, right? And as always, please don't hesitate to comment. I'm always looking for your comments. Where is that at? Here we go. I'm always looking for your comments. You're watching with the team. Okay, that's what's up, JC. So if you have any comments, questions along the way, please do not hesitate to ask. That's what I'm here for. That's why I'm doing this Sunday Skool. I want you to know exactly which way you're going to go. And maybe you need more communication, more conversation, more education on this if you want to become a private lender. If you do, if I didn't answer your question today, as always, just reach out to me. I got you. All right. So what are the pros and the cons of becoming a private money lender? We can see here the benefits are this. You get passive income. Who doesn't like passive income, right? I like to call that mailbox money, right? Passive income is an important thing for everybody, because think about it. If you've got your money in the stock market, right? You don't know what the stock market is going to do from day to day, let alone year to year, okay? One thing we know for sure is unless you're investing in certain asset classes, you're not going to get a check every month or every quarter or every year, however your investment played out. You're not going to get that. Now, that money can come to you or it can go back into your IRA or 401k. Of course, if it goes to you, it's taxable. If it doesn't go to you and it goes back there, it's non-taxable. But these are the kinds of things that you have to be aware of when you're investing. And I'll show you why this, being a private lender in the real estate field, or even buying businesses, but that's, again, another conversation. We're going to stick to real estate today. That is telling you, this is a great way for you to go, and we're going to kind of go over that. So it's passive income. You get monthly cash flow, generally speaking. Sometimes it's quarterly. It depends on the investment, right? It always depends on the investment. It's secured by real estate. Why is that important? Why is it being secured by real estate so important? Well, it's important because if someone defaulted, the person that you loaned the money to defaulted, for instance, you've got the real estate to go take. You could just foreclose on the real estate. Maybe you've done some paperwork where it simply just hands over. It's a deed in lieu of foreclosure. And in some states, you can do a preemptive deed in lieu of foreclosure. But you have that, and it allows you to just go file some paperwork with whatever the state filing is, and that's it. The property is back in your possession. You can, at that point, sell it. You can keep it, rent it out, do whatever you want to do with it. Now it is yours, okay? But it's secured by the real estate, whereas the stock market, for instance, it's secured by nothing. It's secured by nothing. Nothing but a guess. Hey, I see you. Welcome. 100. Thank you. But the stock market isn't secured by anything. It's secured by the herd mentality, the whims of the institutional investors. You know, there's no rhyme or reason to it. It's just as much gambling as roulette is. That's just my opinion, right? At some point, some things need to be done, but it's a game that's been around for a long time, and I highly doubt they're going to change it. Very similar to the real estate game, okay? Regulation is regulation, but wouldn't you want your money to be tied into a thing that actually has value? I know I would. So that's the benefit of the having it secured by real estate. Now, going back, as I stated before, you can grow your money tax-free, and you can control the terms. What does that mean? You know, what do you mean, Miles, when you say control terms? I don't understand that. Well, it means this. You might say, this money I can only lend out for maximum 6 months, or maximum 12 months, or maximum 5 years, depending on your goals, your personal financial goals, and the project that you're being propositioned, right? Or the opportunity that you're being propositioned about. So let me give you an example of what that looks like. So let's say there's this single family house, and you need, I don't know, let's just call it, we'll just keep the numbers low. Let's say you need $100,000 to buy it and fix it. And when you're done with it, it's worth $150,000, right? So you go to your private money lender and say, hey, this is what I would do. I say, hey, listen, I want to buy this property. You know, it's going to cost me $70,000 to buy it. It's going to cost me another $30,000 to renovate it. Are you interested in making some money? And if they say yes, I'll take that $100,000. Well, really, we'll do the $70,000 to close the deal. The other $30,000 will stay in an escrow account as the renovations get done. Okay, so I start the renovation, then we're reimbursed from what's remaining in the escrow account. That is a protection for you as the private money lender in a situation like that. That may be a 6-month or a 12-month deal. Adversely, you may be presented with an apartment deal that's going to be a 5 to 7, maybe even a 10-year hold, right? At that point, you're going to say, okay, over this term, will the money that I invest in this beat the market, beat the stock market where it's been sitting? You know, if it's sitting over in this apartment for 5 years, is it going to be better for me to have it there as opposed to having it in the stock market? And believe me, when I tell you that having a quarter or a half a point compounded over time, depending on the amount of money, really does matter. And we're talking probably the difference, as I'll show you here shortly, depending on where you have the money, we're talking a difference between, 2% and 8%. I mean, even 6% and 8%. It's fantastic. If you're typically getting 6% right now on an annualized basis, and you're going to get 8% on the real estate side, that 2% is significant. I don't care if it's $10,000 that you've invested in that. That 2% compounded over time, just that 5 years or 7 years, will be a lot of money. I mean, because it compounds. It just depends on what you do with it, right? Because you're going to take those quarterly or monthly or annual gains, and you're going to put them back into your IRA or your 401k, hopefully to invest somewhere else, right? So that you can make that, because you want to keep that rolling, okay? So that's what it means, terms. I mean, You control the interest rate. You can control the time. You can control the type of properties you want to invest in. You can control the way you want the money to be dispersed, all in an effort to give you, the lender, the comforts you need as the lender, as the bank. I mean, you know what the saying is, he who has the gold, right? You have the gold. You can kind of dictate what that is. Now, the person that's presenting you the deal can say, no, that's too rich. Maybe you negotiate. Maybe you guys walk away from one another, but you have that out there. And I'll tell you, typically, depending on what it is, we'll do interest rates of anywhere between 3% and 8% right now, right? And again, I'll explain to you what the difference is. Why would you do 3%, Miles? Why would you offer me 3% when you're telling me you can offer me 8% as well? We're going to go over what that looks like. I created a very special chart just for you here tonight. All right? Okay, cool. So let's get back to the cons, right? Now, I know it says cows, but we're not going to worry about that right now. I know it says cows. It's supposed to say cons. It doesn't always convert the best, and I didn't change it. Okay, here we go. So the cons. There's no appreciation or depreciation when you're just a straight lender. Now, why is that a con? Why would that be a con? All right, well, let's say you're earning 6% or 5% on this real estate deal, which is below potentially what you could get on average in your IRA or your 401k, right? But that just depends. It depends on how it's being managed, but that's a whole nother conversation. So no appreciation, meaning the value of the property is going to go up, presumably, but you're not going to participate in that as the straight lender. The depreciation is something that you get at the end of the year when you do your taxes, right? On a house, it's a standard depreciation, meaning whatever you paid for the house. I mean, there's a couple different ways that you can do it, but the way that I like to do it is just a standard depreciation as opposed to writing off the interest, which is whatever you paid for it divided by 27 and a half. Okay. So you don't get to partake in that. It's not you as the lender. You don't get to benefit from the appreciation or the depreciation. You just don't. Okay. So, and if that's something that you want to do, then you have to look at other ways to make that happen. Again, something we'll talk about as we move forward. But just note, if you're going to be the straight lender, you need to be somewhere between 6 and 8%. You have to be as a private money lender. You have to be there, right? Anything less, you'd be hurting yourself unless you're taking equity. If it's just straight lending, you got to get that as a private lender, okay? Now, what's the difference between private? I didn't write this down, but there's a difference between private money and hard money. And here's the difference. You'll see, and if you're an investor and you've been looking for money, okay, just like I'm about to tell you, if you go online and search for private money lenders, you're just hit with a list of hard money lenders that call themselves private money lenders, right? What's the difference? The difference is this. First, it's in the interest rate. Hard money lenders are going to charge you anywhere right now between 11 and 15% again, okay? It's very expensive, and you have to go through this whole process of getting appraisals done and maybe getting CMAs and getting inspections and showing your bank information and your credit report and your this and your that. The same stuff you're going to do when you go get any other loan. So it's like, okay, if you're telling me the deal is the thing, why do I have to go through all of this? Hard money is hard money. Even private money is expensive money, but it's not as expensive as hard money. Those people that run those hard money companies, they do it in a couple different ways. And this is a way for you to figure out how you can take advantage of this as well. But they will go out and raise capital from their network of people to loan it out in real estate. But if they're borrowing it at 8%, they're loaning it out at 10, 11, 12% plus points, blah, blah, all this other stuff. They're making money kind of hand over fist. Okay. Even though, depending on how they're structured, sometimes the company is on there as the lender. Sometimes, depending on, again, how that company works, the individual person that loaned the money even if there are multiple people, will be on title. But there's several different ways to structure that. We'll kind of touch on some of that today. If I go through all of that, we'll be here till tomorrow, okay? and maybe we need to be here till tomorrow. I don't know. Hey, I don't have anything to do tomorrow but work. How about y'all? This is my work. But this is what it is. So, okay, you don't get to participate in any of that whatsoever, right? So, going back. Now, another one is inflation protection. You don't get to participate in that either. And that is in direct correlation to no appreciation and no depreciation. So what does that look like in real time? What does it look like in real time for you to not have inflation protection? Okay, well, we've seen it. As a regular, ordinary person today, over the course of the last year and a half, let's just call it 2 years, really the last year and a half, the price of goods has seemingly really, really gotten out of whack, really expensive, right? And some of that is due to the supply chain issues, supply and demand. There's a demand for a thing that's short supply, it pushes prices up, right? Some of that rings true. It's true. The bigger part of that is the inflation that we continue to hear about. What that means is your dollar is worth less money. When there's 10% appreciation, as we had, which some people don't believe, but the reality of it is that's where we were. We were at 10, maybe even higher, depending on the economist you listen to. But that means that your dollar is now only worth 90 cents. That's it. That's what it's worth. So that hurts you financially. It puts you in a really, really tough spot over time. You have to have income producing things that are beating inflation for you to win, right? Here in America, they like to keep inflation at around 2%, 2.1, 2.3%. They're cool with that. Even 2.8. If it went up to 3%, they're kind of freaking out a little bit. So they like to be in the 2s, 2.5 or less. That's where they want to be. So you have to earn more than 2%. Now, let me break it down for you real quick in your IRA or your 401k. The company that runs that, the fiduciary, is also making money. Now, how do they make money? Okay. They make money when you make money. So as you're buying things inside that, that monetary system, whoever it is, Charles Schwab, Chase, whoever it is, they're getting a small piece, a small percentage to manage that. So that could be 1%. It could be 1.5%, right? So if it's 1%, just being super, super conservative, if it's 1%, now you have to, your IRA and 401k has to beat 3.5% a year. It has to beat that, right? Because that's what inflation means for you. Because you have to count that percent, whatever their fee is on an annualized basis. You have to count that because it's coming straight out of your pocket. You're just not feeling it because it's sitting over there somewhere. So you have to count that. So now you got to beat 3.5%, 4%. And there's other fees and things that you have to think about, taxes and so on and so forth, but we won't get that deep. So you've got to earn 4% or more straight away. Wouldn't you want to guarantee as much of a guarantee that you could get anyway? When you're investing in the stock market, there's no guarantee that something's not going to fall off a cliff. That's why they tell you to diversify inside those IRAs and 401ks. Don't be so heavy in this. Don't be so heavy in that. But the younger you are, you can go ahead and be a little more aggressive and be in the, tech sector or whatever, the biotech sector or the whatever sector, and be heavy in those places that you enjoy, the things that you interact with more often than not. As you get older, they want you to be in T-bills and bonds and all these other things that are giving you minuscule rates of return that are barely beating inflation. A lot of times they're not beating inflation, actually. And that's where you have your money sitting, right? So if you're 25 years old, 25 to 35, you're probably being aggressive and you're hoping that this sector doesn't fall off a cliff, right? Because if it does, you lose the vast majority of our money. Well, you only lose it if you cash it out, right? If you let it roll, maybe it'll go back up, maybe it won't. It should, but as we know, things can happen. This company can go under. This could be bought out. There could be leveraged buyouts. Who knows? You could lose money on the stock. Things happen, right? Things happen. So I'd want to be, me personally, I want to be more comfortable with where my money is. So if I can get, for lack of a better term, a guaranteed 8% return on this property annualized, I know for sure I'm beating inflation by 4.5% under normal circumstances. I know that I'm doing that. I'm cool with that. And if the people that I've invested in, because you're investing in people, it's not just the property. You want to make sure that the property can win as well, but really you're investing in people. So whoever you decide to invest with, you know, like, and trust them. So you believe in this project, and if the project is 6 months, if it's 12 months, if it's 5 years, whatever it is, you've agreed on this particular term, the rate, the term, and everything works out for you because you're beating inflation the way you want to, and you're growing the money the way you want to grow it. Another way that some of these private money and hard money lenders work is, I have a friend who does this actually. He had a very successful business, sold the business, made, I don't know how many millions of dollars, but it was a lot of money, right? He made a lot of money, and he did not want to leave the real estate space. He just wanted to shift his focus. He didn't want to be the guy that fixes houses and apartments anymore. He didn't want to manage anymore. He didn't want really anything to do with it anymore. So he became a lender. And so he put the money in the bank. He borrowed the money from himself, meaning however much money he put in the bank, it's earning whatever it's earning, right? In his case, he put it into a high yield CD, I believe it was. And then he borrowed against it. At the time, I think it was a 10-year thing, and it's different all the time, and I'm going to show you what some of that looks like. At the time, it was like 5%, which it's about what it is today, the best ones anyway, if you can find them, and there's a few that are out there. So that's 5%. Now, let's just use $10 million because he got somewhere in that area. So he's got $10 million sitting over there, and let's say he borrowed 70% of it, but he borrowed it and he has to make a payment on it, but that 10% is earning 5% interest. It's still earning. Okay. He borrowed it from himself. Now he's paying the loan back as people pay him, but he got a line of credit basically for $7 million, we'll call it. Now, I don't know that these are his exact numbers, but I'm just telling you what the banks do. So now he's got $7 million to put out here in the street, but he's putting it out there at 11 and 12%. He's like one of the hard money lenders that you go to when everyone else said no to you, right? Because of you, right? Not because of the project, because maybe you didn't have the experience and they don't want to deal with you. Maybe you've got bad credit and they don't want to deal with you. You don't meet their credit standards. Whatever the case is, people wind up on his phone. They're calling him. And when they call him, he's going to loan that $7 million out at 12% interest plus 2 or 3 points, right? Let's just call it 2 points. So 2% on $7 million, and he does 12-month loans, okay? So 2% on $7 million is what? 10% is $140,000 off the top that he gets the minute he loans the money out. Then he's getting, right now, I think he's at 13%, right? So 13% on 7 million is what? Annually. That's 700,000, 910,000 plus 140,000 is $1,050,000. That's how much he makes a year leveraging cash that he already has. And yeah, he has a note that he has to pay, right? He definitely has that, but he's also earning 5% interest on the money that's still sitting in that CD. That's how you leverage that. That's how you leverage it. So instead of him now he could have kept that cash and put that hard cash to work for himself. He could have done that and not paid that 5%. But guess what happens over time? Over time, as you pay that back, you go to a situation where you have an uncollateralized loan. And now They just give you a line of credit that you can go and do your thing with, but it's not attached to his certificate of deposit, his CD anymore. So he's just paying. He's just earning, He's just earning. Okay. So that's an example of how some people can kind of finagle that. But I want to show you really, really quickly. Let's see. I'll go over here first. Let me share my screen with you. I want to show you. And again, if I'm moving too fast, if you have some questions, please, by all means, put it in the comments. Let me answer your questions. I want to make sure that you're leaving here with a ton of information. All this information is going to be useful, again, whether you're raising money or you're the person that has some money and you're thinking about loaning it out. All right. So let me share my screen. Let me go back here. I want to show you just the stock market really, really quickly. What the stock market has done. This is just in the past 5 years, right? So you'll see here. Come here, we're at 24,000, 23,600, and then we go over here, we're at 32,800. So it's not quite 30%, but let's just call it 30%. This is what the stock market did, 30% in the past 5 years. 30% in the past 5 years. With that big dip, of course, you know, that was COVID. But 30% in the past 5 years. You might be saying, well, Miles, that's a fantastic return. And you know what? It's not bad. 6%. That's 6% annualized, right? Compounding interest is probably a little bit less, but it's 6%. That's what it is. It's 6%. Can you do better in real estate? Absolutely. You saw that big dip and you had to wait. I don't even know how long you had to wait for here. So February 12th, let me share. I'm going to share this with you so you can see it, so you can see what I'm looking at here. All right, so right here at February 12th, we start to see our big dip from 29.5. It dips all the way down on, what is that, March 18th, March 20th, March 23rd to 18.5. That is a huge dip. So it took from March 23rd of 2020 just to get back normal. Let me see here. Just to get back normal. It took about 9 months to get back to normalcy. It took about 9 months to get back to normalcy. And then we just saw this boom. And when we're here at these double peaks, that means something in the stock market world. I don't know what, though. You'd have to ask somebody in the stock market. But that's what it did, 6%. Let's call it 5.5% compounded year over year. You can do better in real estate. Absolutely phenomenally better, right? But that's what the stock market did. Let me show you these CDs, because I know some of you have money in CDs and you put it there because you want it to be safe. It's not something that is as liquid as you want them. Yeah, you can go in and cash it out right away and pay whatever the penalty is for doing that. And if you have a penalty and you want to lend, borrow against it. Don't cash it out. The penalty would be too ridiculous. All right. So let me share with you what these CDs look like. Okay. So here's Capital One. This is one of the best, and they change daily. You have to know that they change daily. All right. 5%. Again, real estate can give you 8%. Now this is a guarantee. They'll say, look, you got $500 because there's no minimum deposit. It has to be in there for at least 11 months. And we're going to give you 5% a year, which means you're not going to quite earn the whole 5% at all. Go down here. What is this? Marcus by Goldman Sachs, 4.5%. Minimum of $500, 1 year. Citi or CIT, whatever that is, 4.65. Synchrony Bank, 5%. I know they change all the time. Ally, 5%. So Synchrony and Ally, just so you know, they're offering those higher interest rates because they do a lot of, I don't know, how do you call it? They lend a lot of money to people that have marginal credit. right? So the interest rates are a lot higher. So they pull in these deposits so they can loan them out, and they do credit cards, they do cars, they do that kind of thing. And they also have banks now. They're actual banks. So they're pulling in all this money so they can lend it out. They're paying you 5%. They're taking your money, okay? And they're telling you it needs to be in there for a year and a half, like Ally says it right there. That's how long it needs to be in there, because they know how long it's going to take them to turn that money, okay? Ally is a big auto lender. They do a lot of other things, but they're a big auto lender. They are one of the lenders that lend at second chance car dealerships. Not the only ones. I mean, you can get them at big car lots too, because they give people, really good interest rates on vehicles if you have the credit worthiness and so, the game. So going back to what I was saying here, they're going to take your deposit. They're going to pay you 5%, but they're loaning it out to people at 24%, 28%. You see what I'm saying? And they're getting these huge payments. And a lot of times they're, bi-weekly payments, but it doesn't matter. It comes in on a month. They're just huge payments. Just think about that. They're paying 5%, but they're charging 25%, right? They're getting 20% on your money. On your money. That's how real this stuff is. All right. And so it looks like, oh man, 5%, 4.65%, 4.5%, it looks all great. And then we get into what the real numbers are, because again, these are, Sally Mae, they're not going anywhere. Right. So you have to know what it is you're trying to get into. 4.5%, it's not really nuts. Wells Fargo's only paying 1.5%. And as you, let me see, if we just do more, look at Bank of America is paying 0.03%. Chase is 0.01%. So we've got a lot of them that are in the fours. I mean, it just keeps going down. That's where we are right now, because they have to have some incentive to bring people in. And believe me, when I was looking at this Friday, there were numbers that were very, very different. As I told you, they change on a consistent basis. By the way, let me tell you, the Fed meets this month. I don't know when. Can't remember when. But it's inevitable that interest rate's going to wind up going back up. So be aware of that, okay? Be aware of that. Now, you saw what CDs pay you. You saw what real estate does, right? I showed you what the Dow Jones did. You're at 6%, 5.5%. Same way you are here in your CD, but the CD has more of a guarantee on their 5% as opposed to the 5 or 5.5% that the stock market is doing. There's no guarantee, right? So I want to show you real estate just over the past few years. So look here. Home prices continue to rise as supply dwindles, which we're seeing. So we go down here and we can see from 2017 to 2022, this was the end of 2022. So this is, housing. The values just go up. These are just values. I didn't want to get into actual inventory reports. I just wanted to show you the values, right? The values just went up from 2017. They just went up. And we know that even at 2017, those numbers were even higher than they were 5 years prior to that, from 2012, because what we were coming out of, right? We were coming out of the financial crisis. We were coming out of the worst recession we've seen since the Depression. And that's real. That's what that is. And home prices over the past 15 years have just gone up, and up. There's been a couple dips here and there, but this is where you want your money to be. And lastly, let me share this chart with you. It's not a chart, actually. It's an article. And this article was written by a government agency. I can't remember which one. I just took a screenshot so I could share it with you, but I'll pull it out and find it. House price change 10 years in the United States. So in 10 years, you'll see here, and I don't know if you can see that well, but there has been a 109.45% increase in value over the past 10 years. Even Canada's had 99.94% increase in value over the past decade. That is absolutely incredible. I mean, it's just incredible. You know, those are numbers that are just insane. Those are real numbers, though. And that's why I'm telling you, if you want to become a private money lender, this is where you start. This is where you start. You say, look, man, I need to readdress what I'm doing with my retirement account and how I want to do this. Well, there's different things that you need to do. You have to talk to a fiduciary. Depending on what it's in, IRA, 401k, you're going to invest through a fiduciary into that. You can also borrow against it. If you're happy with the returns that it's making, you'll wind up paying yourself about 4% interest, which is nothing, but you're paying you. Okay? You're paying yourself. Now, that fiduciary is going to also get a piece of that. Let me just put that out there. So if you're paying yourself 4%, they're probably going to get 25% of that just for facilitating it. All right. So there's different ways for you to go about it. You just have to have a conversation with people that can steer you, give you the right information and steer you in the right direction, to talk to people that can absolutely help you out with whatever your situation is. Okay. But I think that it's important, especially in the climate that we're in today, I think that it's important for you to take full advantage of whatever resources you have. We've got people that took out loans, literally took out lines of credit to be private money lenders because they were getting loans so cheap. They're not doing it so much right now, but I mean, a regular line of credit. Some people took out HELOCs to do it. You know, they borrowed against, I mean, we've done it. You know, every so many years we refinance our properties and we wind up with a chunk of money that we need to reallocate. So some of that goes into more assets. Some of it goes into some of the lending stuff that we do because it keeps the money turning. You know, it has to be in motion. It has to constantly be in circulation, because if it's not in circulation, you fall victim to inflation. Okay. I know that a lot of people like to look at their money sitting in the bank and they like to look at their commas and their zeros. Hey, that's great. Cash flow is better than cash, man, because you can leverage cash flow as well. We live in America, okay? And I know that as a business person, utilizing leverage, debt, helps you out. As an individual, listen to Dave Ramsey, all right? I mean, as an individual, you want to be debt-free, right? You don't want to have the weight of everything on you. But as a corporation or whatever business entity you are, debt is your friend. It's the only way that you're going to get ahead, unless you win the lottery. But even then, you're going to take out loans. You're going to take out loans. You just kind of have to. I mean, you could spend your cash, but then you're banking on something that's inevitable. So you leverage it, right? You could take $100,000 and leverage that into $500,000 in a month's time, 45 days time, for real. You just have to know how to do it. Now, moving right along, I want to share this chart with you because I'll be able to kind of break some things down. And if you can't see this, I'm going to do everything in my power to try to, there we go. There we go. Sometimes I forget the access to technology that I have. I don't even know how to use it most of the time. So forget it. All right. So here we are. Now, here are some examples of what this looks like. And I know I was kind of all over the place. I feel like I was, right on deck, the way I was delivering the information. But if there's something that I was going a little too fast on, you just have to let me know, right? Let me see. Yeah, I can't get it. That's fine. All right. So here's what this would look like for you. Well, for any lender, right? Anybody that's lending. So you'll see here, right here. Let me get this right here. These are all the different kind of things that you're going to be able to dictate and control, right? So from private lending standpoint, the percentage of the purchase, interest rate on cash, the origination fee, or points as we like to call them, the term, the time length, if there's an extension, what that looks like, how much it's going to cost, and percentage of ownership. Now, as I mentioned earlier, and I'll get to that here in a second. So we'll go to the interest only one, okay? Interest only. As a private lender, you only want to lend 80% maximum on that property. And then you'll say, Miles, 80% of what? 80% of acquisition and renovation. So in the scenario that we were talking about, right? In the scenario we were talking about, buying a property for $100,000. It's $70,000 to acquire it, and it is $30,000 to renovate it. Now, sometimes we'll go to people and we'll say, hey, we need the whole $100,000. But you as the lender really do want to protect yourself, right? So you'll want to be in that thing like 80%. I mean, you want to protect yourself. If there's no upside, you don't have any equity or anything like that, you need to protect your capital. And the way that you protect your capital is by saying, okay, Mr. Miles, that's great. I'll give you $80,000. You come up with the other $20,000. I'll give you the $80,000. Okay, perfect. That's what you want to do because you're preserving your capital. Because guess what? If I don't fulfill my obligation, you'll be able to sell that house. And even then you can structure that 80%. You can do it. You could say, look, I'll give you 100% of renovation, the renovation cost, but I'm only going to give you 80% of acquisition. Because you can control the disbursement of the renovation cost. You can control that. You might say, okay, well, here's $7,500 up front to get started. And once you get that done, I'll give you another $7,500. I mean, you can do it any way you want. I'm just giving you examples, right? You can do it any way you want. But if you're only getting interest, you want to protect, and this is if you're loaning on a house, right? Like loaning straight away on a house. And again, there's different ways to go about doing this. That's straight away. I couldn't put every example on here because we'd be talking forever because different deals do different things. There's subject to deals where, it might cost me, $40,000, $50,000, $60,000 to get into this house. There might not even be any equity in that house, but it's the exit strategy that you'll be more like, how are you going to pay me, Miles? Okay, you're going to buy this house for $300,000. It's worth $300,000. You're going to take this money and you're going to do the renovation and give them their walking papers or catch up their mortgage. Okay, I get all of that. How am I going to get paid back? So that's what we have to discuss. All right, how long do you want to? You're going to charge me 8% on that money. Going back to the example, you're going to charge me 8% on that money. You might say, okay, Miles, I'm not going to charge you any points up front, or maybe I charge you 1, maybe I charge you 2, maybe I charge you 0. But if you need an extension, I'm going to charge you 2 points for sure. That means 2% of the outstanding balance, right? 2% of the outstanding balance. And you also don't have any ownership at all in this particular property. 0% ownership in the deal at all, period, point blank, done. Going on to example number 2 right here. This is equity only. So if you're doing, again, the purchase price, you'll go up to 110%. There will be no interest. There will be no points. These are terms that will go anywhere between 1 and 5 years. If there needs to be an extension, the extension is it's across the board. It's going to be 2 points. And your percentage now of equity will be up to 50%. That's how I would want to structure those deals personally. Now, why would that be good for you? Why would having equity be good for you? I'm going to explain that when we go through the hybrid. So let's get back into the hybrid, right? Hybrid is the last one. Boom. Now the hybrid is up to 50% of the purchase price. Okay, an example there might be I'm looking for a partner to come into a deal. I'm putting my credit on the line. I'm getting a hard money loan, but I need the upfront money or whatever, blah, blah, blah. This is what I need. You're going to go up to 50%. So you typically today, that'll be generally anywhere between 20 and 30%, but up to 50% because you can structure things in a lot of different ways. Your interest on cash, because you're not going to get more than 50% of the equity. So you're going to probably be somewhere between, well, it doesn't matter. You're going to get up to 50%. And the money that you put out, you charge anywhere between 3 and 5% per year. The more equity you have, the lower that interest winds up being. Okay, I just want to be clear. Now, in your origination fee and points, it's generally sometimes. I mean, we do these if we have to do if we have to do this because we're offering so much equity. We kind of bypass the origination points. We don't want to do that because we're giving so much already. But as a lender, you can ask for it. Why not ask? Why not ask for it? I mean, it's your money, right? It's your money. You can ask for whatever you want. It doesn't mean you're going to get it. It doesn't mean you're not going to get it. What if I have complicated? Okay, so I'm going to get right to that question there, Mike. So as I was saying, it's your money, so you have to ask. You have to ask what it is you want. For what it is you want, because you just might get it. You just might get it. So ask. You're the bank. Ask. Just ask. Okay. If there is an extension, that's going to be across the board. It's your money. You can stand firm on that. I would recommend that you do that. And your percentage of ownership will generally be anywhere between 10 and 20% if you're doing both. Sometimes it can be a little bit higher. It just depends. Every deal is different. It depends on the numbers in the deal, right? It depends on the numbers in the deal. Now, let me get back to what I was saying. Now, why is it important for you to have some of that equity? Like in example number 2, you have absolutely no interest coming in. There's no interest rate. There's no origination fee. There's no points except for an extension. So, but I get up to 50% in equity. And even in the hybrid, I'll get anywhere between 10 and 30% in equity. But in the hybrid, I've got a payment coming in every month. I've got maybe some origination points coming in, but there's money coming in every month that's being added to my retirement account, my retirement plan. There's money coming in every single month. I can see it. Even if it was just, $200 or $300, I can see it going in there, right? It feels a certain kind of way. But why is the equity so important? Let me tell you why. Because of the depreciation. So if you have, I'm going to use just easy numbers. If we bought a house together, right, using your cash, and we paid $275,000 for it, right? And you got 50% of the deal. You and I are 50-50 in the deal. And there's a potential $75,000 profit, $60,000 to $70,000 profit, right? But we got to hold it for a couple of years. That $275,000, if we depreciate that using standard depreciation over 27 and a half years, is $10,000 a year in deductions. Just that one place, just that one house. If you own 50% of the equity, you get 50% of the write-off, 50% of the depreciation. So every year, you're going to have a $5,000 write-off just because of this. So not only are you earning money if you're using an IRA or a 401k or some kind of a pension fund, not only are you earning your percentage of income or whatever that is over there, depending on which way you go, equity only or hybrid, in a hybrid, you're earning money there, but you're also getting that depreciation based on your percentage of ownership, based on your percentage of ownership. Now, it doesn't get any better than that. I mean, that's crazy. So if we used your money to do a deal like this, and you're getting 5%, let's just keep it simple, 5% in a year's time on $275,000 is what? It's $27,500, and half of that is $13,500, $13,750. $13,750 cash has hit your account this year in your retirement account. Then you personally have a depreciation of $5,000. So if you made, I don't know, $60,000 a year because of that depreciation, that's a loss on real estate owned, Now you're only paying taxes on $55,000, right? You'd have to talk to your tax professional about all of that. I am not a tax professional. I'm only speaking off my personal experience. So you definitely want to have a conversation with your tax professional about that. But I can tell you that's how we do it around these parts. So let's see. Mike says, let me read this here. Mike, he says, hello, sir. This is Mike from San Francisco. Hello, Mike from San Francisco. This is my man, Money Mike G. What's going on? What if I have complications in the renovations or tenants that won't get out? Is there a calculation for the extra time and the monthly payments, or do I have to file paperwork? Or question. Okay, let me see if I can unpack that. If you have complications in the renovations, we'll start there. 9 times out of 10, you have complications in renovations. There's almost always something that is unseen, and you didn't account for it. We try to make sure that we put a 10% buffer in all of our budgets so that, you know, we can do that, but it's either we're borrowing it or it comes out of pocket. Either way, those things kind of happen, right? So if you're talking about money from someone else, so if you borrowed money from someone else, I'm just trying to put it all together. If you borrowed money from someone else to do this particular project, and let's say you said I need 6 months, and then it winds up being 9 months, you have to pay that extension after 6 months. Whatever the terms are on the original note that you signed, you have to adhere to that, okay? So if there's complications in the renovations or a tenant that won't get out, you have to put them out, figure out what you got to do. How much longer is this renovation going to take now that we've uncovered this thing? How much longer is the renovation going to take now that we've got to throw this tenant out? What is going to be the process? What's going to be the timeline? You know, and then really it's anybody's guess. Not in an absolutely horrible way, because we're getting back to what I would call normalcy in the world after COVID, but in some places, evictions are, you know, really quick, under 30 days. In some places, even before COVID, they would take quite a while. And that's pretty much the same, you know, pretty much. And it's not a political thing. Maybe it is a political thing, but in a lot of the blue states, they're tenant friendly. So it's very difficult to get them out. And I'm talking about states that are, you know, their political structure is democratic. It's very difficult to, it's not really pro business. It's not pro landlord. It's not pro landlord at all, really. So they have, they look at you like you're just, you know, money bags, you know, you've got it all. Like you got all the paper in the world. And so if people don't pay you, you'll figure it out. You figured it out this far, you'll figure it out. That's how, you know, the Democrats kind of look at us. In democratic cities, not overall, but in democratic cities. For anybody that's in New York, you know how difficult it is to kick somebody out, you know, even foreclose on them, because it's a judicial state. Chicago, same way, specifically Cook County. Anywhere that it gets really cold, it's tough. Not anywhere, because you can go into certain parts of dare I say the Northwest, but not too far west, more inland, where, you know, things are a little bit slower and a little bit different. It's easier to put people out in some of those places. So anything south of the Mason-Dixon line is generally a lot easier. So I hope that answered your question, Mike. I really hope that answered your question, because when you have these kind of holdups, there's certain things you can do beforehand to not have those kind of holdups, or to do your best to prevent those kind of holdups, but you can't prevent everything, right? You just got to know it's coming. What I do in my renovations is I try to get ahead. I try to get like a week ahead as fast as possible, like right out of the gate. If I have demos scheduled for a whole week, it just depends on the project. But if I have demos scheduled for the whole week, if I can beat it, you know, by a couple days going in the next week, I'm good. And then I'm going to see if I can get another day or two going into the next phase of the project. That That time saves me money, and I manage them in that way. Our project managers manage them in that way. If we're not thinking like that, because every day it literally costs you money. It literally, if you had to borrow, let's use that same thing, $275,000, and you were paying the interest on it at, we'll just say $14,000 a month. I'm just going to do the math here quickly for you, just so you know how much it costs you a day. $14,000 a year, divided by 365. It costs you $38.35 a day, not counting interest, not counting insurance, and not counting taxes. That's just interest. Just in interest, it costs you $38.35 a day. That might not seem like much, but believe me when I tell you, it adds up. It adds up really, really quickly, and you want to make sure that you're covering yourself. It is that important. Now, let me say this in closing, y'all. I heard Mr. Neil deGrasse Tyson say something today and this morning. I don't know when he actually said it. That is huge. It's very huge. But I don't know when he actually said it. I just heard it this morning for the first time, and I'm not, I'm not quoting him verbatim. This is my rendition of what he said. But he said, listen, out of all the humans that could have been and are not, you are but one. You are someone. Think of it just biologically. You as a person, the human that you are. So we get caught up in all of this worldly stuff, and things get really difficult sometimes, or seemingly difficult. We get caught up in it, but you don't realize it. You already won the lottery. Think about it. You were one sperm that made it through tens of millions of sperm to fertilize that one egg that was waiting for you. You were strong enough, fast enough, wise enough, as a however many celled organism that is, to make it there and then get to this world and then grow up in this world to be here, to have opportunity. You already won the lottery. Every one of us that's walking this earth has won the lottery based on the trillions of people that will never be, that did never make it, that never fertilized that egg. So don't take your time for granted. Use this little bit of time that we have on this earth to make something happen for yourself. Don't waste any time. The faster you get into what you're good at, the more you can affect change. The more positivity you'll be able to share with the world. Whatever your gift is, you'll be able to share it with the world longer if you get there sooner. And that's not a pitch. That's just reality. If you figured out at 20 that you were, some computer whiz and you live to your 80, you're going to be contributing to society for a very long time, possibly even things that will change the way we live our lives. It doesn't matter what you do. The one person that you talk to, that you talk to about the struggle that you went through, that you talk to about the win that you had, the hope that you gave them, the caution that you gave them, that experience that you voiced at some point will resonate in the back of that person's mind and make them go left when they wanted to go right. Because you already won the lottery and they did too. Walk the rest of this day and tomorrow and every day after that like you're a lottery winner, because your number got called the day you were born. Live like it. This is your man, Miles. Thank you so very much for your time. I hope this was beneficial for you. If you have more questions, please reach out. Let me know what you need to know. If you're interested, we've got deals that we're always putting out there that we want to share with people. Let's have a conversation about how you can take advantage of it, or just become a private money lender to whoever you want to. You just want some more information. Give me a call. Let's have a conversation and let's make it happen. Let's make some money together. This is your man, Miles. Peace. Thank you so much for being here. What's going on, friends and family? How y'all feeling today? I hope you're feeling great, doing well. I've had a lot of conversations over the past, I'd probably say about the past couple months, 2-3 months, about people wanting to get involved in real estate and asking how they can get involved in real estate given all that's going on with the economy. Well, you either have a lot of time, which means you don't have the money, or you have a lot of money, which means you don't have the time. And they want to know how they can get involved in real estate. Some of them have said, look, man, what do I need to do to just get into a deal, right? I don't really have the time to do all of that. So we've just invested their money in some of the deals that we do. So I'm here to open the invitation to all my friends and family that are watching this right now. If you're interested in getting involved in real estate and you simply don't have a ton of money or you don't have a ton of time, maybe you only have, $5,000, maybe you have $100,000, I don't know. But if you're interested in investing in real estate deals passively, truly passively, just reach out to me. There's no link, this isn't an ad, just DM me and let's have a conversation. We've got deals right now that we can fund. Right now, as of right now, multifamily as well as single family, deals that you can be in as little as 6 months and as much as 2 or 3 years, depends on the scenario and what your particular investment strategy is. All I can say is let's have a conversation. So if you're interested, friends and family, just reach out, let's have a conversation. I'll see you later. Peace.